Hello, I'm Sean, and this is episode 2 of What is Accounting and How Do I Do It? Today, I'm going to walk through what an income statement is, sometimes referred to as a profit and loss or P&L for short. It's only going to take about 10 or 15 minutes, not too difficult to understand. In future episodes, I'm going to walk you through how to prepare it and what goes into that and how do you do that. So with that, I have an example that I want to start with here. This is Crocs 2024 10K. And what that is, that's their annual financial statements that they file with the SEC. And Crocs, yes, you heard me right. The Crocs like the shoe. Um, I thought this would be a good example because they have a nice, easy to read, simple income statement. They call it consolidated statements of income, because they're fancy. Consolidated just means that they have multiple legal entities that they've combined into one. But you can ignore that. Just think of it income statement, profit and loss, P&L. You can call it what you want. Um, what an income statement is it shows like the name, your income or loss, your profit or loss for a specific period of time. So you could run this for a month, a quarter, a year, whatever, even a week or 2 weeks, whatever period of time you want to look at. And this shows you your revenue and expenses for that period. You'd also have income tax expense on here and your net income. So what this isn't, is showing how much cash you've earned, because certain cash transactions don't get recorded to the income statement. This is telling you how much money you've made from operating your business. So for instance, if you spend cash on a building to buy a building or a car or something like that, that's not going to come on. That's not going to show up on your income statement. What this shows is your expenses and your income. So when a customer pays you for a service or product, um, and any expenses you may have associated with that, like rent for your office, um, the cost of the product that you sold. So I'm going to run through each of these line items fairly quickly here because there's not a whole lot to this. Um, this usually comes pretty quickly to most small business owners because this is what the bread and butter of their business. So top line revenue. That's how much money that your customers either owe you or have paid you. So you might have a receivable from them. You've performed the work, and once you perform the work that you've been contracted for, or you've delivered your product to them, you now have revenue. You have income. And so that's where that goes. So you may have collected cash at the point of sale. If you're like a restaurant or you own a store or something like that, you may get the cash right away. In other businesses like service industries where you're performing the work over a period of time, you might not bill right away. You might bill in increments, in which case you'd have a receivable from them for a period of time. But all the revenue goes in there as soon as you've done the work or delivered the product. Cost of sales. This is often referred to as cost of goods sold. You might hear COGS for short. Um, that is exactly what it sounds like. That is the cost. So if you're selling a physical product like Croc shoes, that is the cost of the shoe. What it cost to make the shoe, what Crocs cost was to make that shoe. So it might cost them $5 or $2. I don't even know how expensive Crocs are, but if it might cost them $5 or $10 to make each shoe. Maybe they sell it for $20. You don't. It's not shown net. You're doing the whole amount. So if they sell a Crocs shoe for $30, they're going to put $30 in the revenue line. If that shoe cost them $10 to make, they put $10 in the cost of sales line. And that's how and then you just take revenue minus the cost, and that gets you this gross profit. That's just very simple. How much money did you get for the shoe, and how expensive was that shoe to make? That's it. And so sometimes you hear people say below the line, above the line. This is what they're talking about. Gross profit is that line. So this is the core of your business. Everything else is indirect. So then you see this line, Crocs just lumps everything into selling, general, and administrative. What is that? That's all the indirect stuff. So they have offices. I don't know if they have retail stores. They may. Um, they have accounting expenses. They got to pay their own CPAs, other things like that. Whatever that may be, overhead is often what people think of when they see this. And what that means is any expense that didn't go directly into the creation of the product. So if you have someone who's working using physically in a factory making the shoe, that is a direct cost of making the Croc shoe, because you can't make the shoe without that person. But you can make the shoe without an accountant in your back office or a salesperson or marketing. You might not be able to sell the shoe without marketing, and your business might not be able to operate without that accountant, but you can still make the shoe. So those indirect costs like utilities and the accountants and all and such, marketing, that's what goes in this selling, general, and administrative line. And Crocs has this other line, income from operations. There's no real need for that unless you like to see that. But what this is telling you is this is your core. This is your core business, including direct and indirect costs. That's their one. What's this? This is in thousands. So that's 1,021,911,000 that they have in income from operations. Don't worry about this foreign currency gains and losses. That's just because they operate in different countries, and so naturally you have a difference in currency caused by them having to exchange the currency every now and then. But that's what that is. Don't worry about that. Interest income, interest expense. Now they're breaking that out because that's what they like to do. That's how they want to show it, or they might have a accounting disclosure requirement to do that for their investors. Not something you need to worry about. What I will say though is that as a small business, I do not suggest lumping this all into one line. It's going to make it really difficult for you to analyze your expenses period over period. I would be as granular as you're comfortable with. So break it out with, have a line for accounting or book, or some accountants or professional fees. Sometimes people call it. So if you have to hire a lawyer for anything, or an outside accountant who doesn't work for your business, you could put that in there. Then you'd have things like salaries and employee benefits for obviously your employees, people who work for you. And you might also even have rent, if you're renting your office space. Utilities. You may have you may even go as low as having a line for telephone, and individual types of marketing and advertising. However granular you want to get, just go nuts. When you're setting this up, we will get to in a future episode how you go about doing that and what you would look for in QuickBooks or whatever software that you're planning to use or already using. But that's how that works. And then down here, income tax expense benefit. This can get very complex very fast. So generally, I would just do what your tax accountant tells you to do here. Don't worry too much about this, because a large business like Crocs, they're gonna have tax professionals on their staff who compute this, and the um, the accounting rules for recording this are different than the statutory tax rules for filing, in the US or your state. Um, so this can get very complicated. It's not really worth making it complicated for your small business. So I would I would just make this what your CPA, tax professional tells you to do. We're not going to worry about this other stuff. This is public company information, so they just say, okay, hey, we have 1 million shares outstanding. How much money do we make divided by the shares? And that tells investors what they're making per share. But, obviously for a small business, not, especially if it's sole proprietorship, you don't care about that. So that is an income statement or profit and loss, P&L, whatever you would like to call it. And, it really is that simple. Later on, we're going to talk about what goes into this and how do you record these transactions. In the meantime, if you have any questions about anything I talked about today, uh, feel free to comment. I read all the comments and will respond. If there's a future topic you want me to discuss, please let me know. Always looking for content ideas. And also, one last thing before I go. I'm starting a company that delivers resources to small businesses that help them with this process. And that company is called Ledger Ready. You can look us up at ledgerready.work and sign up and subscribe to our newsletter where we put little tidbit accounting tips, very digestible, very plain English information to help you to support you with your accounting and your small business, so you're not having to overthink things and pay your CPAs all kinds of money to answer simple questions. So I hope you'll join us. And that's all for today. See you next time.